All right, it's noon. I'm going to go ahead and get started and let people join for the first couple minutes. I want to go ahead and welcome everyone and thank you for joining us this afternoon for the second part of our two-part webinar series, The Financial Implications of Divorce. My name is Katie Bishop. I'm the marketing coordinator here at Nisivoccia, and myself and Laura Lampron, our marketing director, are excited to welcome you to this program today. I'm pleased to introduce you to our panel, who will be discussing some of the many financial implications associated with a divorce from both a tax and legal perspective. Moderating today's webinar is Harlene Stevens. Harlene is a CPA and tax manager at Nisivoccia. Harlene focuses on individual and business tax planning, as well as leads our specialty dental segment. We're also pleased to welcome Matheu Nunn with Einhorn Barbarito and Alyssa Engleberg with Donahue, Hagen, Klein, and Weisberg, who are both attorneys specializing in family and matrimonial law. Please feel free to ask questions throughout. You'll have that ability in the chat box or the Q&A feature, and we'll address them either as they come or at the end if we have some extra time. As a reminder, today is being recorded and you'll all receive a recording of the webinar after today. So without further ado, I know there's a lot of good information to cover. I'm going to go ahead and pass it over to Harlene. Thanks, guys.
Hi, everybody. Thank you so much for coming and joining the webinar. My name is Harlene Stevens. I'm a tax accountant at Nisivoccia. Primarily, I work with individuals and small businesses, and I think you're going to get a lot of good information today. Part 2 of our series, and I will actually turn it over now to Alyssa and Matt. Thank you.
Thank you. So for any of you who are in part 1 of the seminar, we discussed really, things to do before you get married. And we focused on premarital agreements and exempt assets and the like. So this part of the seminar is really, okay, now you're married, so what happens next? And so once you're married, and let's just assume that you have not entered into a premarital agreement, which we discussed last time, but you want to enter into an agreement. There's something that's called a mid-marriage agreement or a post-nuptial agreement. And that's an agreement between two spouses who intend that for the marriage to continue, but they want to enter into an agreement that will guide, what happens if they get divorced or if something happens to the party. So this differs from a premarital agreement in that it's not in anticipation of marriage, you're already married. And it differs from the third type of agreements, which is called a property settlement agreement or a marital settlement agreement. And that's an agreement in contemplation of divorce. A mid-marriage agreement, again, your intention is to stay married, but it is an agreement between two married individuals. So sometimes we see people who want to enter into this if the marriage has deteriorated or if there's an issue in the marriage, but they want to continue the marriage, but they haven't entered into a premarital agreement. So similar to a premarital agreement, a mid-marriage agreement can outline some financial obligations between the spouses or equitable distribution. It can address custody or child support. But the question then becomes whether these mid-marriage agreements are enforceable. And in general, we have very little case law on it, but unlike a premarital agreement, the presumption is they're not enforceable. The court considers them to be inherently coercive. They're generally agreements, the result of one party who wants to continue the marriage and they're desperate for the marriage to survive, and another party uses that to their advantage. So the court sees like a disparity in the bargaining powers of the parties. Unlike a premarital agreement, one party is free to walk away from their relationship prior to marriage. Once you're already in a marriage, it's a lot more difficult to do that. And as I said, generally there's one party that's more desperate to keep the marriage intact. And so that party can be disadvantaged. And unlike a property settlement agreement where, divorce is on the horizon and you're contemplating, how that divorce is going to look, The purpose of a mid-marriage agreement is to continue the marriage. So that's not to say that a mid-marriage agreement won't be enforced and that it's perhaps better than having nothing at all, but it is subject to heightened judicial scrutiny. And the party that's seeking to enforce it really bears the burden of proving it's fair and equitable, which can be difficult to do. So what's interesting though is that a premarital agreement, which we spoke about last time, you can modify that actually during the marriage, which can be deemed similar to a mid-marriage agreement, but in general, a premarital agreement that's modified will be enforceable, unlike a mid-marriage agreement. So assuming you don't have a mid-marriage agreement and divorce is on the horizon, as I said, the third type of agreement is called a property settlement agreement or a marital settlement agreement. And this is, what's done in contemplation of divorce. And so I'm now going to turn to Matt to address, some of the issues that will be addressed in those type of agreements in a divorce.
So just one other comment on mid-marriage agreements, and Alyssa covered this, but I think it bears mentioning. In the cases that have enforced mid-marriage agreements, in almost all of them, there has been a complaint for divorce that had been filed. And that really is sort of the line of demarcation that there's been a breakdown in the relationship. And without that breakdown in the relationship, courts generally won't enforce a mid-marriage agreement unless it's stemming from a prenuptial agreement and you're really amending a prenuptial agreement. Property settlement agreements. So assume you filed a complaint, that you're litigating your case, you're tired of paying your attorneys and your accountants money, and you want to settle your case and move on. You enter into what's called a marital settlement agreement or property settlement agreement. And it can contain various areas: alimony, child support, equitable distribution, life insurance, payment of taxes, how certain inheritances will be treated. In any case where there are children in New Jersey, the primary focus of the judge is custody. We're not here to talk about custody. If any of you have been through a divorce or know someone that has and children are involved, oftentimes custody disputes are the things that lead to a significant amount of litigation. However, part and parcel of physical custody and who's going to have, which parenting time is child support, education expenses, and in certain instances, you may have children that have special needs. Particularly in New Jersey, we happen to have high incidences of children with special needs. So as a baseline, you should all know, if you and your spouse make, and this is a net after-tax figure, $187,200 per year of net income, okay, or less, you are covered by something called the child support guidelines. And the child support guidelines, basically you plug in the parties' incomes, whether any alimony is going to be paid to either side, how much parenting time each side has, and these guidelines spit out a number. And that is the amount that one parent would pay to the other account, to the other parent. As a general notion, if you have a child support guidelines case, so it's $187,200 a year or less, no one's going to get rich off of child support. Okay, it's supposed to meet the children's needs, and so people sometimes try and look at alimony and child support, and although they're somewhat related, alimony is really, when you hear these stories on the news and things like that about these big alimony awards, child support typically pales in comparison to alimony. So also part and parcel of child support and custody is education expenses, and most notably college. So interestingly, for those of you who are currently married and have children, there is no case in New Jersey that says you, as an intact married couple, must pay for your children's college education, or that you must contribute to it. Okay. Conversely, if you and that same spouse get divorced and a year later, little Johnny or Susie is ready to go off to college and you find yourself in court fighting about college and college expenses, judges in New Jersey have authority to compel divorcing or divorced parents to pay for little Johnny's college. And you may be scratching your head and saying, well, what if I can't afford it? When courts assess whether to compel parents to pay for college or to what extent, They certainly take into account the financial circumstances of the parties. And in many instances, courts will limit the obligation of parents to pay for college, basically in an amount above and beyond any federal subsidized, and then in some instances, unsubsidized student loans that a child get, or grants or other financial aid through college. But this often, we've seen cases, sometimes, in fact, some of them have been in the news in Morris County, where, parents basically try and emancipate their kids. I mean, in a post-divorce setting, you have two divorced parents who can't agree on anything other than, hey, I don't want to pay for my kid's college. Courts generally won't do that so long as the child has attempted to maintain or actually does maintain a relationship with their parents. The last area that we see a lot of litigation and also planning, my office does a lot of trust and estate planning, are special needs children. And one of the reasons we do that is as a child with special needs reaches the age of majority, they may or may not ever be emancipated in terms of a divorce case. Emancipation meaning a child can move beyond the sphere of influence of their parents. They can go have a home, a job, and do those things. That's not what I'm talking about in terms of age of majority. When a child reaches the age of majority and has special needs and can never take care of themselves, they're entitled to government benefits. Here's the problem. If a parent is paying child support to the other parent for little Johnny, who's now 18 and can never take care of himself in the future, child support basically could, in some circumstances, eliminate little Johnny's availability to get governmental benefits. So there are workarounds. There are things we do to plan against that. And so you can set up special needs trusts, either a first party or a third party special needs trust. I won't get into what the difference is, but there are differences. And you can deposit support to a child into that trust. And basically, it's a way to avoid having the federal government disqualify an 18-year-old, but in my words, still a child, an 18-year-old from receiving governmental benefits. So if you have a case or you know someone who's dealing with a child that has special needs, and when I say special needs, I mean to the extent that the child will never be able to take care of himself or herself and will be in future in government housing in the future, or basically will never be self-sufficient. You really need to look into the issue of whether a special needs trust or a supplemental needs trust in certain circumstances should be established. The other issue is extreme income families. So I mentioned the child support guidelines stop at $187,200. Okay, and if that's what you have, you get a number that's pursuant to a set of guidelines. If the parties' incomes combined, our net incomes, are higher than $187,200, and I'm talking in New Jersey, we have people who have hundreds of millions of dollars and make $30, $40, $50 million a year. Child support in those cases are outside of the guidelines, and then a court will examine the child support statute, which contains a list of factors that the court is to consider when establishing child support. And I've had cases where, I've had people pay $20,000, $30,000, $40,000 of child support a month, and the alimony could be $100,000 a month. And if that would be, that's a really truly extreme income situation. I say this to people: the goal of child support ultimately, whether it's guidelines or an extreme income case, is to make it so that if Matt and Alyssa are divorced, and Alyssa makes $10 million a year and Matt makes $20,000 a year, and we have 3 children together, yes, under those circumstances, Alyssa would most likely be paying me alimony. Thanks, Alyssa. But the goal ultimately is to make it so that our 3 children under those circumstances wouldn't be living the lap of luxury at Alyssa's house and want to be at Alyssa's house and never want to come spend time with dad because I live in a loft and the children don't have privacy and we can't go on vacation and we can't do things. So when you're thinking about child support, it's not necessarily to put the parties' incomes or financial positions in equipoise or equal to each other, but it's to make it so that one party is not up here and one party is not down here in terms of establishing the children's lifestyle with each parent. So I think Harlene is going to be talking or has some commentary about medical expenses or some questions.
Right. So, and this really deals with divorced, people who are divorced, and also people who, maybe pay medical expenses for someone else that that they could, can claim as a dependent. So the medical expenses, irregardless of who the custodial parent is, the medical expenses can be claimed by the parent who pays the medical expenses. So if you have, one child, and let's say the husband gets the deduction for the child, but the ex-wife is paying the medical expenses, she will be able to get the medical expense deduction, for the child. Now, that's an interesting thing. Even when you talk about special needs, there are a lot more medical expenses that could be deductible for a special needs child, including a special school that could be necessary or something like that. So you could run in under certain circumstances to large medical expenses. And as you may know, the deduction for medical expenses is usually dependent upon income. It's a percentage of your income. So something to think about, if there is a party with large medical expenses, it may benefit one party to pay those medical expenses, even if there's some kind of, reimbursement amongst the two parties, depending on how that works. So just something to keep in mind in terms of the deduction for the medical expenses.
And if both parties are contributing toward the medical expenses, can they both deduct what they're each paying?
Absolutely. They can both deduct what they're each paying, for sure. So it's basically whoever pays for it is getting the, getting the deduction for it.
Okay. I just wanted to mention one other thing with child support, that in New Jersey, there's not an automatic age that child support ends. And as Matt spoke a little bit about the special needs trust, but even if you have a child who's not special needs, after that child's 18, if they're continuing on to college, they may still have to pay child support. It may not be in conjunction with the guidelines if the child's living away at school, but there is still some sort of child support obligation that continues until the child's emancipated, which is a pretty broad definition, but generally it's, until a child graduates college. I don't know, Matt, if you have anything else to add on the child support.
No, that's a great point. Thank you for, as always, picking up the slack where I omitted something. But generally speaking, if a child goes away to college, and I mean a full-time college where they're away 9-10 months of the year, the parent who is receiving child support, again, generally speaking, will be reduced to reflect the reduction in certain costs that the parent would have from the child living at home. For example, I'll use, a child who's going to, University of Florida and is there 9-10 months of the year. The food expense for mom, if mom is the primary custodial parent, isn't going to be the same while that child is away at college, again, because the parents are probably paying for a food plan or something for their college age child. So just know that once children either graduate from high school and get a full-time job, child support typically terminates at that point, once a child has a full-time job, or the other is you may find yourself back in court once college rolls around if the parties can't agree on reductions of child support for a child who's away at college.
Okay. And then the next topic is, and Matt touched upon it briefly, is alimony, which can be tied into child support depending on, if you're paying alimony or receiving alimony, that's considered as part of your income, whether it's the guidelines or calculating child support outside the guidelines. So what is alimony? It's essentially an obligation for a party to pay his or her former spouse. But there's different types of alimony in New Jersey. There's actually 4 different types. One is called open durational alimony. This is really available to marriages that are more than 20 years, and open durational, it's not really a word, but it just means that there's no set end date. It's typically, like I said, it's usually for marriages in excess of 20 years, unless you have exceptional circumstances to allow for it. That doesn't mean that alimony never ends. It just means that there's not a specific date that it ends. It could end, for a multitude of reasons, which I'm not going to get into in this seminar, but there's just not a specific date. Unlike, the second type of alimony, which is called limited duration alimony, and that's generally in marriages that are less than 20 years. It's alimony for a limited period of time. In general, it can't exceed the length of the marriage. So if you're had a 15-year marriage, the limited duration alimony obligation could not exceed 15 years and generally wouldn't even be 15 years, may be somewhere close to that, but except in an exceptional circumstances, again, if you can prove why it wouldn't be fair in your particular case, which is very difficult to do. Then there's a third type of alimony called rehabilitative alimony, and that's really an award based on a plan where the recipient spouse can demonstrate a plan for rehabilitation, usually in terms of employment, if they're trying to get into the workforce, if they're going back to school to get a degree and they need funds, let's just say, to complete their degree, that's a type of alimony that would really allow them to do it and would allow them to be in a job that they're hopefully making more money so that the payor spouse doesn't have to potentially pay them as much. And then the last type of alimony is called reimbursement alimony. And that's really when one spouse supported the other spouse through an advanced education and anticipated the fruits of that labor, and then that never came to fruition. For instance, if one spouse is supporting the other through medical school and their residency, and then right when they're about to get this big job making a ton of money, the spouse files for divorce and is going to be making all this money, and the other spouse who had been working 2 jobs to put them through school really didn't receive any of that benefit. So it's looked at in that regard. And the types of alimony, really, except for a limited duration and open duration durational, they're not mutually exclusive. So you can get reimbursement alimony and limited duration alimony combined together. It really depends on the circumstances of your case, but it's possible. And so then the next question is, well, how is alimony calculated, right? In terms of reimbursement and rehabilitative, it's a little bit more concrete, as I said, in terms of determining what those amounts are. But for open durational or limited duration, unlike child support, there's no formula, regardless of what your income is. And instead, there's a statute, and it identifies a multitude of various factors to assess when calculating an award. And those factors may be weighed differently by different judges. You could present the same facts, and you can have judges analyze it differently, and it's very discretionary. So, and in other states, there are calculators for alimony or calculations, but not in New Jersey. So it really can vary. And it's really fact sensitive depending on the factors. So typically alimony is based on, the circumstances during the marriage and at the time of the divorce, really what you can afford to pay, what the needs are. Those are the big focuses. But sometimes after a divorce, let's just say alimony set, either agreed upon in an agreement or set by a judge at the time of the divorce. And then a few years later, your circumstances change significantly. You lose your job, you had a multi-million-dollar job, you lose that job. You can go back to court, you can get alimony modified. Alimony, unless it's in your agreement that it's non-modifiable, it can be modified based on your circumstances. The burden is on the person who is asking for a modification to prove, why they're entitled to a modification. The amount in a limited duration alimony, the amount can be modified. Generally, the term itself cannot be modified. So you may think, okay, well, it's fair if they're going to be paying less for them to be paying longer, but that's actually not how it works. And in general, except if you can show unusual circumstances, which I have never seen, I'm not aware of any case, Matt, you can jump in, that have found unusual circumstances to extend the term of limited duration alimony. But the amount itself can be modified. Again, it's very discretionary with the judge and your circumstances. And so once alimony is calculated, the next question is, and Harlene, you can weigh in on this, can it be deducted by the payor spouse? Is it paid with after-tax monies, before-tax monies? Is it reported as income to the recipient spouse?
So the alimony rules changed prior to 1/1/19. So up through, if you were divorced up through December 31st, 2018, the way alimony works is whoever pays it gets a deduction, and whoever receives it has to claim it as income. And that is still the case, you know, for anything that happens prior to December 31st, 2018. I think we talked a little yesterday when we were kind of preparing for this webinar that if there is a change, most of the time, I think you said, Alyssa, that they would keep it the way it originally was unless you specifically make a change to that. Is that, I'm not talking about New Jersey now, but just for federal purposes?
If you were divorced prior to December 31st, 2018, and your initial agreement had that it was taxable and deductible, you're essentially grandfathered in, and your agreement would have to say that it's no longer taxable or deductible, and repeal that if you do not want it to be any longer. Otherwise, yes, it can be, but only for those agreements.
Okay. And New Jersey is just totally off the grid. And don't get me started on New Jersey. It's been a bad year for New Jersey tax-wise on many levels. But New Jersey, for some reason, never changed their rules. So technically, if someone gets divorced tomorrow, whoever makes the payment is able to deduct it, and whoever receives it should claim it as income in New Jersey. However, and you guys can weigh in on this, it's my understanding that it is possible to put wording into an agreement that for New Jersey purposes, it would be handled just as it is for federal. And I don't really have very many, I have a number of divorces prior to 2018, but the ones I have subsequent, most of them we are handling the same way that we do, you know, for federal. So you guys can weigh in on that. How
Harlene, I have yet to hear of anyone divorced, so 19 or 20, post the tax changes federally. I've yet to hear of anyone who was audited or received a deficiency letter from the state of New Jersey on this issue. So my understanding is, and by the way, I actually think on the Division of Taxation, the New Jersey Division of Taxation website, there might be a comment or an article. I remember looking at this where they stopped just short of saying we're going to treat it exactly like the federal government does, but basically they will honor agreements. They will honor the federal income tax changes. So I wouldn't be worried too much about it, but it is prudent to include in a settlement agreement language that says New Jersey shall be non-taxable as well.
Yeah, and sometimes we just have general language that it's non-taxable and non-deductible.
Yeah.
And then it would apply to both, but
yeah,
makes sense.
So I think next up is equitable distribution. Okay, equitable, what does that mean? We hear it a lot in a different context today, but equitable at its core means fairness. So when I have people consult with me, I say to them, when we get to this subject of equitable distribution, and I don't mean to sound like a child, I'm speaking to a child when I say this, but consider like a big bucket. And from the day you were married until the day a complaint for divorce is filed, every asset you acquire, every dollar that you earn, every debt that you incur goes into that bucket. And it is the role of the judge or the attorneys who are representing you to settle it, or a judge if you can't, to determine how to divide those assets in the most fair way. Now, in many cases, that literally means 50% of all debts and assets get divided between the parties, okay? However, we are not a 50-50 presumption state. There are some states, out west in particular, that are considered community property states, and the presumption is that everything is 50-50. New Jersey does not have that presumption. However, over the course of time, most, as my experience, and I think Alyssa will agree, most cases are 50-50. Alyssa is going to talk a little bit about inheritance and gifts and things that are exempt from equitable distribution. But again, generally speaking, most assets are divided 50-50, subject to businesses, which I'm going to speak about in a moment. But The easiest thing to divide in a divorce case, assuming you're not fighting about who spent what or who was out engaged in nefarious conduct and spending the family's money on things that they shouldn't have been spending it on. Bank accounts, checking and savings accounts. Those are the easiest thing to divide. And I say easy. It may require you and your spouse to go down to a bank together or to close an account or transfer some money. But bank accounts, you're talking apples to apples when you're dividing a checking and savings account, right? It's cash, it's on hand, it's easy to divide. Things become a bit more complicated when you're going through a divorce case and you have brokerage accounts or some other stock account, and I'm talking about non-retirement accounts. Because you may have two brokerage accounts, and let's say on paper they're both worth $200,000 because that's what the market's at. But we can all appreciate this. One account may have $100,000 of capital gains, and the other may have $5,000. If you're representing the spouse that has all of the capital gains, you don't want your client. You don't want to say, okay, I'm just going to keep my client's brokerage account, which has all these capital gains, and you, other party that has like no capital gains, you keep that account. Because think about it conceptually. Although on paper they're worth the same, they're really not, because for my client in that scenario, for her to actually access the $200,000, she's going to have to pay taxes on it in the future. So when we have a big money case where there's hundreds of thousands, millions of dollars, and a lot of different stock transactions have gone in the accounts, we typically get accountants involved to make sure that the transactions are in kind, which means if Alyssa and I are getting a divorce and we have 2 shares of Apple stock, we're each going to get a share of Apple stock. And we're not going to fight about, well, I want the 2 Apples and you get the 2 Microsofts. It's typically an in-kind division of assets. But you really need to make sure you don't commit malpractice or make a bad deal for yourself if you're the one going through the divorce. You really have to pay attention to which accounts are getting divided to make sure you're not getting stuck with the account that has all of the future tax consequences. The next subject is the distribution of businesses. Okay, this is where the accountants on the call perk up and the forensic accountants make all of their money, sometimes more than the attorneys. Businesses in a New Jersey divorce case are subject to equitable distribution. Now you may say to yourself, so a judge is going to order me to sell the business? Or they're going to order me to work with my spouse? Generally speaking, that is not how it's handled. If any of you who are participating or listening to Harlene works for an accounting firm, know businesses frequently get valued, okay, because people want to sell them. There are other reasons to do it, but when you go out on the market to try and sell your business and you have an appraiser come in, they do what's called a fair market value, okay? What's someone on the street willing to buy? Okay, what are they willing to pay for it, right? And when you're doing something like that, if I'm going to sell my 47% interest and Alyssa has 53%, clearly my interest is not as valuable as Alyssa's, right? Because I don't have the controlling interest in the company. Okay, a fair market value analysis would take that into consideration. Okay, it's important for you to know that in 99% of divorce cases in New Jersey, we apply something called a fair value standard. And although it has some of the hallmarks of a fair market value analysis or valuation, there are no adjustments for minority interest, which I just discussed. I have the minority shareholder status and the lack of control of the company. And there are no marketability discounts, okay? Other than in extraordinary circumstances, which I'm not going to get into, okay? So what does that mean? How does it get valued? I would say, and Alyssa can correct me if I'm wrong, in 90% of divorce cases, we do what's called the capitalization of income method. And basically an accountant, a forensic accountant, will look at the business and they'll determine the total financial benefit to the business owner. So hypothetical, I own a landscaping company. Alyssa has another job. She's never worked in my business before. Okay, I run a lot of expenses through my business. Maybe I'm going to get myself in trouble that I do this, but I report $100,000 a year of income on my tax return. But in reality, there are perks I receive. I receive cash that I don't report. An accountant's going to come in and they're going to determine the actual financial benefit. So maybe it's $200,000 a year instead of $100. Okay, And then they're going to capitalize that income stream over a period of time. And they'll take a deduction against it for reasonable compensation. And then they'll come up with a value for it. So, if I say my reasonable compensation is artificially low or artificially high, the forensic accountant may say, well, I've looked at what other owners of landscaper companies in New Jersey make, and this person is lying about the reasonable compensation for themselves. So in this scenario, assuming I'm the owner of the business and Alyssa has her own job doing something else, generally speaking, in those scenarios, the value of the business is not divided 50-50. It's usually some lesser percentage for the non-business participation spouse. I see it anywhere from 20% on the really, really low end to 40% on the higher end. I've been involved in cases where I had clients who worked in, I'm thinking one off the top of my mind, worked in her husband's business. She kept the books and records, answered the phones. She ended up getting 43% of the value of the business because she was an integral part of the business. There is one other approach that, for those of you that are accountants, you'll appreciate this. In some cases, take a masonry company or a landscaping company, something that has heavy equipment. In some cases, the better approach to take, or the more accurate one, is the asset approach. And quite literally, you would get commercial appraisals done of all of the equipment and assets owned by the business. Not the depreciated amounts that appear on a tax return, but the actual current values for sale purposes of the assets. Those will be appraised, and we would determine a buyout based on the value of the assets. So those are really the two ways, I'd say two of the primary ways to value a business. But the capitalization of income approach is done in the overwhelming majority of cases, and we typically get accountants involved to assist with these types of issues. I think, Alyssa, I'm going to kick it over to you for retirement assets.
Yep. So another asset to divide in a divorce is retirement assets. And so how we divide retirement assets really depends on the type of retirement asset. So there's different methods in dividing those. And there's something called the Employment Retirement Income Security Act of 1974, which is also known as ERISA. So that guides many of the defined employer-sponsored plans, such as 401ks, and sometimes 403bs, 401as, 457s. It really depends on the type of plan. And those plans have to be divided by what's called a qualified domestic relations order, also known as a quadro, which will essentially set aside a separate benefit for the recipient spouse. It's sent to the plan administrator, and it sets forth their own separate account generally, depending on the type of plan. If it's an IRA, most of those plans will have some type of form, or we'll do letters of instruction, or there'll be a rollover, transfer to transfer. Quadros can't be submitted to an IRA. They're really just for the employer plans. And so then the question becomes, and for those type of plans, which are not even getting into pensions right now, but for those type of defined benefit plans, is the creation of a separate account, Harlene, does that become a taxable event when that occurs? You're on mute.
Sorry about that. So basically, the thing you really have to keep in mind, whether you're, the quadro, the IRA, you want to make sure that it's a direct rollover. So you want to make sure that it goes into another retirement plan. So they call you may hear the words trustee to trustee transfer, and that's really what you want to make sure you do. I have had clients who've gotten distributions from their spouses. One woman in particular, a number of years ago, she got a distribution from her husband's retirement plan. I don't think it was a quattro. I think it was probably an IRA. It might have been a quattro, but then she sold it or whatever, and she ended up with a lot of taxes due because Generally, if you're under age 59 and a half and you take it out prematurely, you are also going to pay a penalty on it. I was researching that this morning because I thought that there was an exception, and I didn't see that there was an exception generally for that. I mean, there are certain exceptions that you wouldn't have to pay the penalty, but generally you do. So the most important thing that you want to make sure of is that, no, it is not going to be taxable as long as you roll it over into, another account. Another IRA or, account. That's what you really want to do.
So then the question is, when is the recipient spouse, when are they entitled to those benefits? And again, that really depends on the plan. If it's a defined benefit plan, they may be able to access it right away, but then there will be tax consequences or early penalty consequences. But if it's some kind of a deferred compensation plan or a pension plan, they'll have to wait until the participant spouse is getting paid to receive their share. And a lot of times with those type of plans, we'll calculate a valuation with a buyout so that the spouse doesn't have to wait, and there'll be a discount for that if it's paid up front. But it really depends on the type of plan and whether that's even possible, depending on the assets of the spouses. So Matt, I don't know if you have anything else to add in terms of retirement assets.
No, I think you both covered it really well. Just the one thing that this is more of a practical thing. If you're dealing with a case where there are quadros that need to be executed and then sent to the court and then sent to the plan administrator of the plans, the ERISA plans, this tends to fall off everyone's radar, and it can lead to malpractice and really some significant post-judgment issues. And I'll just leave you with this example. Divorced in 2019, there's a quadro for Alyssa's 401k. Matt and Alyssa never do anything about it. Alyssa's 401k explodes in value, or Alyssa engages in day trading in her 401k and diminishes the value substantially. And Matt, have never done anything to pursue the quadro. What's a court going to do when I go to the court and say, well, wait a second. Alyssa's 401k was $1 million and now it's $200,000 because she was buying, some type of cryptocurrency that's basically valueless now. There are cases that talk about this and talk about the party's expectations and the prudence and the activities of the spouse that controls the 401k. So what's my point? Strike while the iron is hot and the divorce is still in your mind. And even though you may think, I have my judgment of divorce, I'm done, we split the bank accounts and brokerage accounts, make sure you follow up and get the quadro done and don't forget about it. Because I'm telling you, I have people who come to me 3, 4, 5 years later from other attorneys, and they say, oh my God, I never did the quadro, I never split the retirement account.
And sometimes it also depends on how your divorce judgment is worded. If it says, 50% of the value as of this date, subject to passive gains and losses, if someone is actively trading against the account, you may have a better argument there. But yeah, the longer you wait, the more difficult it's going to be for either side to make those arguments. So the next thing that I'm going to discuss is, inheritances, gifts, exempt assets. And at the first part of the seminar, we discussed this in terms of, prior to the marriage and what you should do with any kind of gifts, inheritances, exempt assets that you have prior to the marriage or that you receive during the marriage. And most importantly, keep those assets separate, because once they're put into a joint account, put into joint names, considered commingled, it's much more difficult to parse that out. And so in a divorce, if you're claiming that something is an inheritance, a gift, an exempt asset, the party that's making that claim has the burden to prove that. And so depending on, what the claim is and what documents you have, it can be very easy to prove, or it can become more difficult to prove. But it's important to note that, let's just say you're able to prove I got this inheritance, and sometimes, like I said, it's easy if you have like an inherited IRA and it's still in the name of whoever it was inherited from, and you never put anything else into it. It's pretty straightforward. But if it's an inherited IRA and then there's required distributions or it's producing income, the income from those exempt assets, even if the asset itself is exempt, can be considered. So if it throws off income, it can be considered in terms of when, establishing child support or alimony, or just considering the different circumstances of the parties. So it's important to note that in there, that even if the asset itself is not going to be considered, some of the income it throws off, won't similarly be exempt. So, Harlene, I think you're going to talk a little bit now about taxes and how you should file, when you're going through a divorce, especially if the divorce is not finalized by December 31st, but you're going through the process.
Right. So, there's a lot of ways to look at this, right? Because you could look at it as what you can do, what you should do. I mean, I'm a tax person. So for me, I'm like, okay, do whatever it is that you have to do so that you both pay the least amount of tax. That's kind of my, my philosophy in looking at taxes in general. But basically, if you are, let's say you're separated, but not yet divorced on December 31st, and you're living apart, most of the time there is an agreement to that effect that, sometimes it's, I guess, I don't know what it's called. You have here an indemnification agreement, but wasn't there another name, pendente lite or something like that?
Pendente lite is support that you're paying prior to the judgment
Correct.
of divorce, while it's pending.
Correct. So let's say there's something like that there's an agreement and you're living separately, then you have the right to file either married filing separately, or if there are children involved and it's pretty much a joint custody kind of thing, and they're living with, each parent, let's say 6 months, a year, then you can both file as head of household, which is really the way you would want to file, because it's more advantageous than filing separate. So you do have that option. So you have to kind of look and see where you're at as of December 31st. A lot of times clients will file married filing joint just because they feel like they get the better bang for the buck at that point. And also, with head of household, which is the, one of the ways that you would want to file, that you have to look at the certain, what the requirements are. And generally it's that you have one or more of the children living with you more than 6 months or more of the year. And each of the parent can have that. So you could have one child, and the child lives with one parent 6 months, the other child 6 months of the year. Sometimes I think you guys would put that in an agreement, but from a tax perspective, that's the way it's done. This year is a little funky because there were these advanced child credit payments that actually went out during the year. People who got those payments would have gotten something called a letter 6419. And what that means, it's a look back. So it's looking back at 2020 or 2019 to see who claimed the child. And in the case of, if people are divorced, that could change from year to year, depending on the agreement. So I think it's going to be this year for sure, for myself and other tax accountants. It's going to be a little bit of a pain to try to figure that out, because, we want to see the letter. Depending on the income of whatever the income is, and it's not very high, if someone got those advance payments and they weren't supposed to get them, they might have to pay it back. So that's going to be a little funky for this year in particular. The same thing with the child's care credit. It's depending on who gets the child, who can claim the child. What I have seen with divorced clients in the past is I might have a a husband and wife, and the wife is supposed to get the exemption for the child, but the husband, the ex-husband, files his return first and takes the dependent care credit, okay? And then the wife goes to file the return, and let's say she should have gotten the credit or whatever, or vice versa, and the IRS denies it because they match up the numbers, and so they don't get it. So you really have to make sure, sometimes, even though it's not comfortable, you do have to have a conversation with your ex to make sure that you're not double dipping. Because the IRS will find that. They're pretty good at finding when two people try to take the same deduction for the same thing. And then the other thing just to think about, which I'm not going to get into because it can really be a whole discussion amongst itself, is innocent spouse relief. So let's say the marriage was bad for a long time. The husband was filing, returns, let's say one of the spouses had a business and they were doing kind of shady things or whatever, but they were reporting it with a personal return. The one spouse hands the return to the other spouse and says, here, just sign it, like they've been doing for years and years without even looking at it. And it turns out that there was some stuff there that was not 100% kosher, not above the line, and they get audited. There is something called innocent spouse relief, and that is something that, where the innocent spouse would not be held responsible for the errors or omissions of the other spouse. So that's pretty much my end of the child part of it.
So I think last up, I'm going to talk a little bit. We only have a few minutes left. Insurance and security for alimony, child support, and equitable distribution. So what do I mean by that? I'll give you an example. Let's say I owe Alyssa $100,000 a year of non-taxable alimony for 10 years, right? So I owe her $1 million over the course of 10 years. Well, what if I die after 1 year? She's not getting alimony from me anymore. I'm in the ground, right? So what do we do to prepare for that or to prevent an inequitable situation? In most, if not all, divorce cases, the parties will either be compelled or agree under that circumstance that I, Matt, would have the obligation to maintain a life insurance policy to make sure that Alyssa gets the benefit of her deal, her alimony. Now, in many agreements we see, each year that I pay the $100,000 in full, I'm entitled to reduce the death benefit. So after 1 year, I could reduce it to $900 and so on and so on. A similar logic applies to child support and college, meaning, we don't want a situation where Alyssa and I have kids together and I'm supposed to be paying alimony and child support and I'm supposed to be putting money away for college and I die and I haven't done any of these things, right? Because then Alyssa and the kids will all be left without, and courts tend to want to avoid those types of circumstances. So most agreements provide life insurance provisions. It is very important. I've written a couple of articles about this with some of my colleagues at my office. I had a case go to the Supreme Court about life insurance issues, and a prior counsel whose language was drafted poorly, and it ended up in the Supreme Court about the interpretation of the language. So you need to be specific. People tend to think of these life insurance provisions in their agreements as sort of throw-ins that they're going to do at the end of the agreement. You need to be precise about what the life insurance is intended to do, who it's intended to benefit, for what purpose. And then finally, life insurance for equitable distribution. I'm going to use pensions, for example, as my first example. A teacher's pension in New Jersey, or a PERS pension, so a non-police or fire pension, okay? Those pensions allow for death benefits and beneficiary status to exist in a former spouse. So if I'm married to a teacher and we get divorced and I have an interest in her pension, even though we're divorced, I can still receive my share of the pension after her retirement, okay? If you are married to a police officer or fireman and you get divorced, you can no longer get your spousal share of that pension benefit after that spouse dies, okay? So after the pensioner, the husband or wife who was the employee as a police or fireman, died, the pension benefit ends. There is no survivor benefit for a former divorced spouse. So what most cases do, we agree to some amount of life insurance to make sure that in a police or fire case, the spouse gets his or her share of the pension benefit. And then the final thing is, there are some cases you can imagine where people, maybe you have an older divorce, the people are in their 70s or 80s, and there's an issue with how to divide certain assets, or someone has stock that they can't sell because they're a member of a board. We can engage in estate planning to compel that party's estate to pay the deceased person's share of equitable distribution. You can imagine that these types of things are very complex. We work with accountants. I work with trust estates and attorneys in my office to figure all of this out. But the details regarding these types of things matter, because if you do not write these agreements properly with regard to these insurance or post-death issues, I assure you, you will be making trust and estates litigators very happy, because they'll have a lot of work to do when your body is in the ground, except your children or other inheritees will be very upset with you that you didn't plan properly for them.
So I think we're going to wrap everything up. I don't see any questions, but I think Katie was going to, yeah, okay. Thank you, Katie. So you have our contact information. If you think of any additional questions, you can certainly email us directly. We'll be happy to answer that. Thank you so much for coming today. And we look forward to having you attend some more of these in the future. Take care.
Thank you.
Bye-bye.
Thank you.
Thanks, everyone.